Hello, everyone, and welcome to Financial Accounting with Anne-Marie Anderson. Today, we will be learning the basics of T accounts. What is a T account? Well, it is simply a visual tool to help organize transactions. Here it is. A T account looks like a T. It has two sides, a left side and a right side. We refer to the left side as a debit and the right side as a credit.
Is it that simple?
Yes, but there's a little bit more to it. Let's go way back. It all started with a 14th century monk/mathematician that came up with the double entry accounting system that we use today. There is some debate as to who actually invented it, but does it really matter? We've been using this system for about 700 years. Back to the T account. The name actually comes from the general ledger because, well, what does that look like to you? Do you see it? No worries. I'll highlight it. Let's begin with how T accounts are used for assets. Asset accounts increase with a debit and decrease with a credit. Cash is an asset account, so if cash is coming into the business, that's a debit. But if cash is coming out of your account, then those would be credits. To find out how much cash we have overall, we draw a line, take the net of the two sides, $1,000 minus $325, that leaves us with $625 debit balance in cash. A debit balance in an asset account is what's known as the normal balance. Shifting gears, we look at liabilities. Liability accounts decrease with a debit and increase with a credit. Accounts payable are bills you have to pay in your business. So if bills come in the mail, then we credit accounts payable to increase the liability account. If we later pay one of those bills, we decrease it with a debit. A credit balance is the normal balance for a liability. The third type of account is stockholders' equity, which follows the same rules as liabilities. It decreases with a debit and increases with a credit. Wait, assets and liabilities make sense, but what is stockholders' equity? Stockholders' equity reflects the ownership value in the business held by shareholders, and it's comprised of several things. The first is capital coming into the business. An owner puts money into the business and usually receives stock in exchange. Dividends is when the business pays out shares of profits to its owners. Revenue is the earnings of the business, and expenses are the costs of earning those revenues. Things like rent, utilities, salaries, and so on. Let's combine that information with our T account. You can see that capital in and revenue are both credits because they increase stockholders' equity, and dividends and expenses are both debits because they decrease stockholders' equity. All three come together to be the accounting equation. Assets equal liabilities plus stockholders' equity. Now let's take it just one step further. If we bring everything we learned so far about T accounts together, here are the rules on one screen. The first rule going in is there must be at least one debit and one credit for each transaction. Now let's do a little practice and actually use these T accounts to prepare journal entries. This is Janice, who runs a pottery store. Looks like a shipment came in. We need to record those supplies in her books. Her journal entry would be a debit to the asset of supplies and a credit to accounts payable. So the first rule applies with at least two transactions. The second rule is that the debits must equal the credits. Great job on the first transaction. Let's move on to the next one. A new customer comes in wanting help to repot her plant, a service Janice provides. Her journal entry would be a debit to cash and then a credit to sales revenue. I think you're getting it. Let's go on to one more. The mail has brought in some utility bills that Janice has to pay. Her journal entry would be a debit to utilities expense and a credit to accounts payable. Now let's pretend a week has passed and prepare the journal entry for paying the bill. It would then be a debit to accounts payable and a credit to cash. Fantastic! Now that you have the hang of T accounts, it's easy to pivot and prepare the formal journal entry written in the general journal. Debits are always written first, and the credits are indented for the second half of the entry. That wraps up T accounts. Thank you for watching. If you want to learn more about accounting, please see additional videos on my channel.